Howdy doody dandy, folks. That's right. We're bombarding the videos this week. That's what it's all about. Here we've got stocks to buy for the week, the month of October, let's say. This is going to be a good one for you. I got 4 stocks, 4 of them. Hope you're excited. We got a lot of good deals. A very bad month of September in the stock market, as historically there always is. September just sucks in the market. I don't know why, but it does. So let's start with, you know he's always here. It's Apple. Why is it always here? Well, come on now. There's a good reason why I have Apple on this month. It's because this has been a stock that's been unfairly mashed in the last month. I said mashed. Down 7% in the last month. Very bad performance, obviously, even in comparison to the general market. And I don't necessarily know where the reasoning becomes behind this. Apple, obviously, most prominently known for iPhone, but obviously we've got the Mac segment, iPad, Apple Watch, the number one wearable from any company, Apple TV, Apple Music. They've got services as well. There's your beautiful Apple Watch. Services like Apple Fitness, again, could get somewhere eventually. Curious what the iPad mini looks like, going on sales-wise, but they even have financial with the card. With the Apple Card. Crazy stuff. Everyone's getting into the financial game. Every company's a fintech company, I swear. Apple TV Plus as well, though. Working on creating more originals. Curious to see what that looks like. But you look at the stock, and I think it's trading relatively cheap, all things considered, compared to historical value. Right? Market cap of $2.4 trillion. You look at me and you say, are you crazy? That's not cheap. That's not cheap at all. But, all things considered, this trading from a P ratio at a cheap standpoint from where it's been historically. 28 trailing PE and a forward P of 26. It's very cheap for the stock's performance. Really is, in my opinion. I mean, this is a stock that's still, the company's growing by massive margins. You look at the revenue on this company, they were able to, in the trailing 12 months here, grow $70 billion on that line in comparison to the year prior. Crazy growth. I mean, it's ridiculous growth. And if you look by segment, this is one thing I love to see. Look at this bad boy. It shows you by segment. Love it. Let's start, obviously, with, we'll get rid of some of the segments we don't care about. Mac and iPad, not one I really look at that much. iPhone. What's iPhone doing? Well, consistent growth. It's a slower growth line, but this is a consistent growth line. And it's going to be a consistent revenue maker for them historically. I mean, obviously, the only way you can really grow iPhone growth in the future is by potentially increasing average selling price, because there's only a limited number of phones that can be sold at a given time. There really is. I mean, not everyone's going to upgrade. Some people upgrade every single year. Some will keep their phone. But there's still a max. You're not going to have 2 phones per people. It doesn't work that way, unfortunately. It's not a product that works that way. But if they're consistently able to either stay with their market share, hold the current market share, or potentially move onward and gain market share, that's how they grow revenue, besides average selling price increasing, because world populations, again, we see increase in populations maybe, then we'll see. But that's a segment I like. What else do I like? The wearable segment. Look at that. That's a chart I love to see from a wearable standpoint. Obviously, you see what Q4 is able to do, too, in terms of some of the sales there, but it's crazy. It's crazy stuff for a sales standpoint. I mean, number one, wearables, and eventually they will go and grow beyond just Apple Watch as they're working into more health devices, but also eventually something like you saw with Facebook, they'll get into some augmented reality glasses. They're going to work on different hardware options, obviously, no doubt. So I really like that about them too. But this is my favorite part. It's the services line. There is not a dip to be seen in the services line. It's going to be a continued avenue of growth, and eventually will take over as the strongest segment. And you compare them all together. Right now, obviously, iPhone wins by a good margin. Just compare the two of them. iPhone wins by a good margin. But there will be a time, in my opinion, over the next year or two that services takes over. You heard it here first. Just because of the fact that you can see this trend, it is an incredible trend line here, and it won't be stopped as they continue to grow users onto the services. So, yeah, that's what you got for Apple. So that's why I like it a lot. My next stock here, we're getting into retail. It's going to be Target. Why are we getting into retail? Also, a stock that has been destroyed over the last month. 7% downward movement. I mean, it's crazy to see. Year to date, great performance. But I think over the last month, it's been unfairly treated. We look at this stock itself, see where it's trading at. This is trading at a trailing PE of 19 and a forward PE of 19.3. Very cheap, all things considered, for what they're able to do. Price to expected growth of 1.83 and 1.24 price to sales. Now, this is one that is trading cheap for the general market standard. We're talking about a PE ratio on the market right now, 35, right around 35. This is trading at a darn cheap rate here. It's trading at a darn cheap valuation, in my opinion. You look at what they've been able to do in terms of the financials and how they've been able to grow consistently year over year over year over year. And obviously, last year was a massive boom for them. Growth of, they significantly grew, really exponentially compared to what they were doing prior. And that's a trend that's going to continue for a lot of reasons. What I really like about this company is e-commerce. You look at the last report, they were able to grow digital sales 10% following a 195% growth last year. But that's not necessarily the segment I love. The segment I love is going to be same-day services. Same-day services, including order pickup, drive up, and shipped, grew 55% this year on top of the 270% growth the year prior. This is where they stand out. They're able to do a great job of not only being a fantastic brick-and-mortar retailer, bringing traffic in there because they're growing traffic as well, by the way. Growing traffic and ticket price. But they're able to see this online sale growth as well. That's really exciting to see for this company. So that's why I like Target. And I think it deserves to be trading a little more expensive compared to some of the other retailers out there. And obviously a good dividend yield in this. The yield's pretty low, 1.58. But it's still shown 53 years of dividend growth and a 5% dividend growth rate. Or 5% 5-year growth rate. So this is a company growing the dividend consistently. They're dedicated to it, and only a 27% payout ratio. So if they wanted to grow it faster, they could. But again, they're going to be more focused on just continuing the growth, steady, and reinvesting their other income elsewhere. But this is great stuff. It's a great stock, great dividend yield, no doubt. My next stock is going to be Kohl's. You know me. I'm back in the retail game again. Why? Look, again, we're talking about bad performance over the last month. 15% downward movement in the last month. 17% down over the last 6 months for Kohl's. Still doing good a year to date, all things considered. But on an annual performance, we've seen good stuff. 5 years out, though, we're still not where we were in 2018. We haven't recovered to that. But I think they deserve to. You look at some of the financials of this company, it's trading very cheap in terms of a valuation standpoint. Market cap of $7.9 billion, trailing PE of 10 or of 11, and a forward PE of 10. It's dirt cheap. The stock's trading dirt cheap. It really is. Price to sales at 0.44. That is right. This is a company bringing in $18 billion of revenue in the trailing 12-month standpoint, yet a market cap of $7.94 billion. Really cheap, really cheap. So what can I say? That is a dirt cheap valuation on this. And on top of that, they bolster a great dividend, 2% yield. They obviously don't have any growth rate because you look, they had to cut it last year because they weren't making the money. But only a 16% payout ratio now at a 2% yield, and they're going to continue to grow that because if you look at the history prior to last year, it's one that's it's a fruitful history of dividends on this company. Not that it's going to necessarily show, of course, because why would it? But fruitful history. Love the dividend on this one. And then I've got one final stock for you today. It's more of an ETF. It's going to be SCHD. Why do I like SCHD here? Well, there's many reasons for it, okay? I still think the market needs to cool off just a little bit. I think last month was a good help for it, but I think it needs to cool off just a little bit. In the meantime, something like SCHD is a great, great bet because not only do they provide decent market gain, they provide a nice dividend as well. So let's look at what this ETF has. You look at the last year's performance, 35% growth. Over the last 5 years, up 79%. It's great performance. Look at the some of the details here that you can come to find with this. distribution yield of 2.82%, as I've highlighted on your right side here. 2.82%, nearly a 3% yield is pretty darn nice in my perspective. We also have a net expense ratio of only 0.06, trading very cheap. Some of the companies they have within their portfolio, obviously worth mentioning, right around 100 holdings. We have Amgen, Broadcom, Cisco, Home Depot, Intelligent Business Machines, IBM, Coca-Cola, Merck, PepsiCo, Texas Instruments, Verizon. These companies. They're very consistent. They pay dividends. They pay dividends consistently. That's what the main focus here of. But we also see great performance on this stock historically. This goes into annual returns by year. We've got 15% growth in 2020, 27 the year prior, down 5%, 20% growth, 16. And you look at that just compared to the Dow, which is mainly what this stock or this ETF invests in. 7%, so SCHD wins. SCHD wins 2019, SCHD wins 2018, SCHD does not win 2017, but it wins 2016, it wins 2015, wins 2014. It just outperforms the general market historically, and it provides a nice yield, which is performing, actually, it's got a higher yield than you see in terms of just a Dow Jones in general. So this is a great ETF in my opinion. It's one that I think is great for times of uncertainty in the market because performance will be good on this one. It's a very well run portfolio and just nice stuff. Just nice stuff. I like it. I like what they're able to do. That's what I got for you, stocks to buy. I hope you have a great day.